Over the past 13 years, the Japanese yen has fallen roughly in half versus the US dollar. And a weaker Japanese yen has had both good aspects and bad aspects for the Japanese economy. Now, the good aspect is inflation, and the bad aspect is also inflation. Inflation in some ways for Japan has been positive. For many decades, Japan was in and out of deflation, meaning that its money was gaining in value versus goods and services. That made it very difficult for the government to ever reduce its budget deficit, which was typically running at around 6% of GDP. And Japan's debt ratio spiraled to over 200% of GDP. So finally, with positive inflation, they have begun to reduce their deficits and their debt ratios. But there's a cost, and the cost is higher consumer prices, which many Japanese consumers are complaining about. In addition to that, the input costs faced by businesses who import goods, say for industrial processes, are also rising. A recent survey by the Japanese Chamber of Commerce inquired what level should the yen be ideally. And the average Japanese business owner said it should see somewhere between 100 and 130 versus the US dollar. But currently it's trading all the way up at 146, which means that the Japanese yen would have to gain anywhere from 10% to as much as 30% versus the dollar to get back into that range. Now, the challenge is, if the Japanese yen were to rally that much versus the dollar, it could push Japan back towards deflation and to derail the government's gains in fiscal responsibility that they've achieved with a weaker yen.